There's a ghost that haunts the portfolios of 99% of investors. It's a whisper, a siren song that promises riches for pennies on the dollar. It's the seductive idea of the bargain, the thrill of the hunt for a stock that the market has supposedly misunderstood, a diamond in the rough that you and only you have the genius to spot. It's the logic that says a stock trading for $5 is mathematically cheaper and therefore a better deal than a stock trading for $500. This ghost has a name. Warren Buffett called it cigar butt investing. The idea is simple. You walk down the street and find a cigar on the ground with only one puff left in it. It's a soggy, disgusting thing, but you pick it up, get that one last puff for free, and then throw it away. In investing terms, this means buying a truly terrible business, a company in decline with broken economics, simply because its stock is trading for less than its liquidation value. You buy it, wait for a tiny dead cat bounce, or for the company to liquidate its assets. You collect your small profit, your one free puff, and you move on to the next soggy cigar butt. This was the gospel according to Benjamin Graham, the father of value investing and Buffett's mentor at Columbia University. For years, this was the only way Buffett knew how to operate. He was a master of it, a quantitative prodigy who could sift through financial manuals and find companies trading for fractions of their net working capital. And it made him a millionaire. But it would never have made him a billionaire, because that final free puff comes at a catastrophic hidden cost. The cost is the time your capital spends trapped in a decaying business. The cost is the brain damage of dealing with failing operations and desperate management. But most importantly, the ultimate cost is the monumental opportunity cost of not owning a truly wonderful business instead. The cheap stock is the enemy of the great investment. This is the story of how Warren Buffett learned that lesson, a lesson so profound it would become the bedrock of a financial empire worth nearly $1 trillion. It is the story of his final promise to himself, to never again shackle his fortune to a mediocre business, no matter how cheap it seemed. And by understanding his journey, you will fundamentally transform your own. You will learn to see the market not as a bargain bin but as a showcase of businesses, and you will learn to pay a fair price for an extraordinary one, because that is the one true path to building generational wealth and achieving lasting financial freedom. Our journey begins not in the gleaming skyscrapers of Omaha, but in the decaying mill towns of New England. This is the first and most painful lesson, the one that forged the foundation of everything to come, the seduction of the cigar butt and Buffett's painful awakening. To understand the monumental shift in his thinking, we must first immerse ourselves in the mind of the young Warren Buffett, the pure, unadulterated disciple of Ben Graham. The year is 1962. Buffett, running his small investment partnership from a home office, is on the hunt for cigar butts. He's scanning pages of Moody's manuals, looking for the classic Graham setup, a company whose stock price is so low that it trades for less than its net current asset value, essentially, its working capital. This means you're getting the business itself, the factories, the equipment, the brand, for less than nothing. It was a statistical arbitrage, a bet that the numbers were so compelling, something good had to happen. And that's when he found it. A struggling textile manufacturer in New Bedford, Massachusetts, named Berkshire Hathaway. From a purely statistical standpoint, Berkshire Hathaway was perfect. It was one of the cheapest stocks in America. The northern textile industry was in a slow, agonizing death spiral, being relentlessly undercut by cheaper, non-unionized labor in the South. Mills were closing left and right. Berkshire itself was a shadow of its former self, closing mills and bleeding cash. But the numbers were beautiful to a Grahamite. The company had a strong balance sheet. Its stock was trading at $7.50 per share, while its net working capital per share was over $10. Buffett began buying the stock aggressively. His plan was simple and classic cigar butt logic. The company was consistently closing mills and using the proceeds to buy back its own shares at a discount. As the number of shares outstanding decreased, the working capital per share for the remaining shares would increase. Buffett could just ride this trend, selling his shares back to the company in a future tender offer at a small profit. A quick, easy puff. In 1964, the moment seemed to arrive. The company's president, a man named Seabury Stanton, made an oral tender offer to Buffett to buy his large block of shares for $11.50 per share. Buffett agreed, but when the official written offer arrived, Stanton had changed the price. The letter offered only $11 3/8. A tiny difference, just an eighth of a point, 12.5 cents per share. But to Buffett, this was a profound betrayal. It was a chiseler's move. And in that moment, something inside him snapped. The cold, calculating Grahamite was replaced by a furious competitor. Instead of selling his shares back to Stanton at the lower price, Buffett went on the warpath. He started buying every share of Berkshire Hathaway he could get his hands on. He became aggressive, hostile. He sought out other shareholders and convinced them to join him. By 1965, he had won. He had controlling interest in Berkshire Hathaway. He promptly fired Seabury Stanton. At the age of 35, Warren Buffett was now in charge of a dying textile business in a dying industry, a business he never actually wanted to own in the first place, all because of a 12.5-cent grudge. This was the beginning of a 20-year nightmare. For 2 decades, Buffett had to deal with the brutal economics of the textile industry. He was now on the other side of the ledger. He wasn't the detached stock picker. He was the owner, the executive responsible for capital allocation. And what he learned was that a bad business will suck the life and capital out of you, no matter how smart you are. The business needed constant investment in new looms and machinery just to stay competitive with foreign rivals who had dramatically lower labor costs. These capital expenditures were huge, but they never resulted in any meaningful increase in earnings. It was like running on a treadmill. You had to pour millions of dollars in, year after year, just to stand still. He was fighting against an unstoppable economic tide. The business consumed cash, it didn't produce it. He would later describe the experience with brutal honesty. It was a terrible business. We were putting more and more money into a business that was earning less and less money. We had a management that was superb, but the industry was just too tough. For 20 years, he and his partner Charlie Munger battled, trying to keep the mills afloat, a sense of duty to the thousands of employees in New Bedford, keeping them in the game far longer than they should have. Finally, in 1985 he surrendered. He closed the last textile mill. The experiment was over. The cigar butt had finally burned down to his fingertips, and the pain was immense. The initial purchase was a mistake, compounding it with a hostile takeover was a mistake, and pouring good money after bad for 2 decades was the biggest mistake of all. It was a lesson written in millions of dollars of lost opportunity, a lesson that would permanently alter his investment DNA. The raw, painful experience with Berkshire Hathaway's textile mills perfectly illuminates the underlying psychological principles that make cigar butts so dangerously seductive. Our brains, honed by millennia of evolution to find bargains and avoid immediate threats, are tragically ill-equipped for the counterintuitive world of long-term investing. The primary cognitive bias at play is the asterisk anchoring bias, TERT. When an investor sees a stock that has fallen from $50 to $5, their brain immediately anchors on that $50 price. The $5 price seems impossibly cheap in comparison. The brain screams, "This is a bargain. It's 90% off." It fails to consider the most important question. Has the underlying value of the business also fallen by 90% or more? The price becomes the entire story, blinding the investor to the deteriorating reality of the business itself. We anchor to the price tag, not the quality of the merchandise. This is amplified by what psychologists call the asterisk action bias, asterisk, the innate human tendency to feel that doing something is better than doing nothing, especially in situations of uncertainty. Sifting through lists of 52-week lows, finding a statistically cheap stock, and clicking the buy button feels proactive. It feels clever. It gives the investor a jolt of dopamine, the satisfaction of having found a hidden gem. It's a treasure hunt. In contrast, the process of identifying a truly wonderful business, a process that might take months of patient research and waiting, can feel passive and boring. The action bias pushes us toward the quick hit, the cigar butt puff, rather than the patient cultivation of a long-term compounder. Compounding is a slow, almost invisible process in its early years, while bargain hunting provides immediate psychological feedback. Furthermore, the allure of the cigar butt plays on the asterisk scarcity heuristic. We are wired to place a higher value on things we perceive as scarce. A stock trading at an absurdly low multiple of its book value feels like a rare, fleeting opportunity. The fear of missing out, FOMO, kicks in. If we don't buy it now, this incredible bargain will disappear. This cognitive shortcut is useful when foraging for rare berries, but in the stock market, it's a trap. What appears to be a scarce opportunity is often a permanent impairment of capital in disguise. The market is not stupid. In today's hyper-connected, data-driven world, a stock is usually cheap for a very, very good reason. The scarcity is an illusion. There's a near-infinite supply of bad businesses trading at low prices. The true scarcity lies in the number of genuinely wonderful, durable enterprises, and our psychological wiring makes us systematically overlook them in favor of the junk pile. Buffett's early success with cigar butts, in a less efficient market, only served to reinforce these biases, creating a powerful feedback loop that took the soul-crushing experience of the Berkshire textile mills to finally break. To avoid this trap, to override these flawed mental shortcuts, we need a practical tool, an applied mental model that forces us to look past the tempting price tag and scrutinize the health of the underlying business. Let's call it asterisk the "is this business getting stronger or weaker?" filter. Asterisk the dot asterisk. It's a simple, yet profoundly effective blueprint to inoculate yourself against the cigar butt siren song. Before you even consider the valuation of a statistically cheap company, you must run it through this qualitative filter. It consists of 4 critical checkpoints. First, you must analyze the asterisk 5-year revenue trend. Pull up the company's income statements for the last 5 years and look at the top line. Is revenue growing? Is it stagnant? Or is it in a clear decline? A cigar butt is almost always a business with declining sales. Customers are leaving, the product is becoming obsolete, or the market is shrinking. A simple line chart of revenue can tell you more about the business's trajectory than 100 valuation ratios. If the world is turning its back on what the company sells, no price is cheap enough. Second, examine the asterisk gross margin trend. Gross margin revenue minus the cost of goods sold is a powerful indicator of a company's pricing power and competitive position. Is the company able to maintain or even expand its margins, or are they being squeezed year after year? A wonderful business can often raise prices to offset inflation without losing customers, keeping its margins healthy. A cigar butt, on the other hand, is usually in a brutal, commodity-like industry, where the only way to compete is to cut prices. Shrinking gross margins are a massive red flag, signaling that any competitive advantage the company once had is eroding to nothing. Third, you must compare capital expenditures to depreciation. This is a slightly more advanced step, but it's where the rubber meets the road. Find the cash flow statement. Depreciation is a non-cash charge that estimates how much of a company's assets were used up in a year. Capital expenditures, or CapEx, is the actual cash the company spends on new property, plants, and equipment. In a healthy, growing business, CapEx might run a bit higher than depreciation as it invests for future growth. But in a dying business like Buffett's textile mills, you often see a horrifying picture: CapEx that consistently and massively outstrips depreciation. This means the company is pouring enormous amounts of cash into its machinery and factories not to grow but simply to stay in the game. It's a capital-intensive black hole. The business is consuming cash, not generating it. Finally, you must honestly assess the asterisk industry headwinds. Step back from the numbers and think about the big picture. Is this company fighting a battle it simply cannot win? Are there technological or cultural shifts that are making its entire industry obsolete? Think of a newspaper publisher in the age of the internet, a video rental store in the age of streaming, or a northern textile mill in the age of globalized manufacturing. Buying a company in a dying industry is like trying to swim up a waterfall. Even with a brilliant management team, the forces arrayed against you are overwhelming. By applying this four-part filter before anything else, you force yourself to confront the business reality. The price becomes a secondary consideration. This blueprint acts as a shield, protecting your portfolio and your wealth management strategy from the seductive but ultimately toxic allure of a cheap price on a deteriorating asset. The failure to apply this kind of filter leads directly to the path walked by 99% of retail investors, the creation of a bargain bin portfolio. This is the antithesis of Buffett's evolved strategy, and it is a near-certain path to financial disappointment. The portfolio of the average bargain hunter looks like a graveyard of once great companies, and never were penny stocks. They are drawn to headlines. A company in the Dow Jones announces a massive accounting scandal. The stock plummets 70% in a week. The bargain hunter, anchored to the old price, swoops in, believing it's the sale of a lifetime. They don't do the hard work of assessing whether the scandal has permanently damaged the company's brand or balance sheet. They just see the discount. They buy a retailer like Sears or JCPenney year after year as it slides into bankruptcy, telling themselves it can't possibly go any lower. They average down, throwing good money after bad, caught in a psychological trap of their own making. The emotional journey of the bargain bin investor is a predictable tragedy. It begins with a rush of excitement and a sense of intellectual superiority. They believe they've outsmarted the market, that they see value where others only see fear. This initial phase is pure hubris. Then, as the stock continues to drift lower or stagnates for years, doubt begins to creep in. They start spending their time defending their decision, seeking out confirming evidence on internet forums, and ignoring the mounting pile of negative news. This is confirmation bias in its purest form. They become emotionally attached to the stock, their identity intertwined with being right about this one pick. When the company finally declares bankruptcy or becomes effectively worthless, the financial loss is compounded by a deep psychological blow. They feel foolish, cheated, and disillusioned with the entire concept of investing. The problem wasn't the market, the problem was their process. They prioritized the illusion of a bargain over the reality of the business. They were so focused on the price of the stock that they forgot to ask if the business itself was worth owning at any price. This path of the 99% is paved with these good intentions and bad outcomes, a direct result of ignoring the painful lesson that Buffett learned in the textile mills of New England. The financial consequences of this mistake are not abstract. They are devastatingly concrete and visible directly on a company's financial statements. A cigar butt is what we call a melting ice cube, and its balance sheet and income statement tell the story of its slow, inevitable demise. The direct financial connection is undeniable. When a bargain hunter points to a low price-to-book ratio as a sign of value, they are often falling for an accounting fiction. The book value of a company like Berkshire's textile mills was composed of assets like looms and factory buildings in New Bedford. On the balance sheet, these assets might be valued at, say, $10 million, but what is their true liquidating value? Who is going to pay millions for obsolete textile machinery in a dying industry? The real market value might be pennies on the dollar, just the scrap value of the metal. So the supposed margin of safety that the investor thought they had in the book value was a complete illusion. But the most catastrophic financial impact is the silent killer of all wealth, opportunity cost. Let's quantify it. Imagine an investor in 1965 puts $10,000 into a classic cigar butt business. Because the business is in decline and requires constant capital reinvestment just to survive, it generates a meager, let's be generous, 2% annual return over the next 20 years. That $10,000 after 2 decades of stress and value turns into about $14,859. Now, consider an alternative. What if that same investor, instead of being seduced by cheapness, had put that $10,000 into a solid, growing, if perhaps slightly more expensive business that was able to compound its intrinsic value at a conservative 15% per year. Over that same 20-year period, their initial $10,000 would have grown to $163,665. That is the difference. It's not a small rounding error. It's a life-altering chasm of over $148,000 on a single $10,000 investment. The capital trapped in the melting ice cube didn't just earn a poor return, it cost the investor a fortune. Every dollar you allocate to a dying business is a dollar that cannot be allocated to a compounding machine. This is the true, brutal mathematics of the cigar butt trap. The financial statements show the decay, but the real damage is the future that was stolen. Buffett's 20 years in the textile wilderness cost him billions in lost compounding, a price so high that it forced him to seek a newer, better, and infinitely more powerful philosophy. The painful 2-decade-long lesson of the Berkshire Hathaway textile mills had carved a deep scar into Buffett's investment psyche. He knew the cigar butt method was a dead end, a path of immense effort for meager rewards. He was primed for a new way of thinking, but he hadn't yet codified it. The intellectual spark that would ignite the second half of his career and transform his portfolio into a colossus of compounding machines came from one man, his partner, Charlie Munger. Munger was the catalyst, the intellectual heavyweight who pushed Buffett to abandon the last vestiges of Graham's statistical bargain hunting and embrace the powerful, beautiful economics of truly wonderful businesses. This was the second great pillar of his transformation, the Munger catalyst, and the discovery of the profound difference between price and value. The foundational anecdote that perfectly captures this paradigm shift is the acquisition of See's Candies in 1972. At the time, Buffett and Munger were presented with the opportunity to buy the beloved California-based chocolate company. See's was a fantastic business. It had a cherished brand, fanatical customer loyalty, and a simple, unchanging product. Families had been buying See's chocolates for holidays and special occasions for generations. It was a part of the cultural fabric of the West Coast. The numbers reflected this. The business required very little capital to operate, no massive factories or expensive R&D, and it gushed free cash flow. The owners, the See family, were asking for a price of $25 million. The young Buffett, the Buffett still haunted by the ghost of Ben Graham, immediately balked. He ran the numbers. See's Candies had only about $8 million in tangible assets, things like inventory and receivables. The $25 million asking price included $17 million of goodwill, which was essentially the value of the brand itself. To a strict Grahamite, paying for goodwill was heresy. Graham taught you to buy assets on the cheap. You certainly didn't pay a premium for something as intangible and fuzzy as a brand name. Buffett's initial instinct was to walk away. The price was too high. It wasn't a cigar butt. This is where Charlie Munger changed the course of financial history. Munger, who had never been as dogmatically devoted to Graham's methods, saw the situation with perfect clarity. He understood that the $17 million in goodwill wasn't an expense. It was the entire asset. The brand was the reason the business was so valuable. It gave See's incredible pricing power. Because customers were emotionally connected to the product, and the purchase was often for a gift or a special occasion, they were not highly sensitive to small price increases. See's could raise its prices by 10% every year, and people would grumble for a moment and then buy the chocolates anyway. This pricing power, combined with the low capital needs, meant See's was a fountain of cash that could be reinvested elsewhere. Munger relentlessly argued the point with Buffett. He pushed him to look beyond the static balance sheet and see the dynamic economic reality of the business. He famously told him, in what would become a cornerstone of the Berkshire philosophy, "It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price." Buffett, to his immense credit, listened. He overrode his ingrained Grahamite instincts and agreed to pay the $25 million. It was one of the most important decisions of his life. See's Candies went on to generate over $2 billion in pre-tax earnings for Berkshire Hathaway over the subsequent decades, a staggering return on their initial investment. And it required very little additional capital. The profits were free to be allocated to other great investments. See's became the prototype, the working model, for the new Berkshire Hathaway. It taught Buffett that the true value of a business lies not in its tangible assets, but in its durable competitive advantage, its economic moat. It taught him that a business that can grow its earnings power over time without needing much new capital is a gift that keeps on giving. The initial purchase price, which seemed so high to him in 1972, quickly became a footnote. The overwhelming power of the business's internal economics dwarfed the initial valuation. The See's Candies deal was the moment Buffett graduated from being a brilliant cigar butt picker to a true capital allocator and a connoisseur of quality, a shift that would unlock tens of billions of dollars in future capital gains. The See's Candies story is a masterclass in the psychology of branding and its effect on consumer behavior. The underlying principle that makes a business like See's so wonderful is a powerful combination of the asterisk endowment effect asterisk and the deep-seated human need for asterisk social proof. The endowment effect is our tendency to value something more highly simply because we own it or have a history with it. For See's customers, the brand wasn't just a product, it was a part of their personal history. They received it as children, they gave it as gifts for anniversaries, they brought it to family gatherings. The brand was endowed with their own positive memories. This creates an incredibly powerful emotional bond that transcends a simple transactional relationship. When a customer walks into a See's store, they aren't just buying chocolate. They are buying nostalgia, tradition, and the certainty of a positive emotional outcome. This emotional connection is what gives the business its legendary pricing power. A competitor could open a store next door selling chemically identical chocolate for 10% less, and most See's customers wouldn't even consider switching. The decision isn't based on a rational analysis of price per ounce. It's an emotional decision. To switch brands would feel like a betrayal of their own memories and traditions. This psychological moat is far more durable than a patent or a factory. It exists in the collective consciousness of millions of customers. From an investor's perspective, appreciating this requires a crucial psychological skill: nose to ride delayed gratification. The cigar butt investor seeks the immediate gratification of buying something cheap, the quick flip, the fast profit. It's a sugar rush. To buy a company like See's Candies, at what seems like a full price, requires the discipline to forego a small, immediate reward for a much, much larger reward in the distant future. It requires you to understand that the compounding of value inside a great business is a slow, quiet process. For the first few years, the genius of the purchase might not be obvious. But as the years turn into decades, the power of consistent, high returns on capital, fueled by pricing power and brand loyalty, creates a wealth-generating avalanche. Munger's genius was in recognizing that the human brain's desire for immediate, tangible bargains is a profound weakness in the world of long-term investing, and that the real fortunes are made by those who can pay up for quality and then patiently wait for that quality to compound. To translate this powerful concept into a practical tool for your own stock analysis, you can use a mental model I call the pricing power litmus test. This is a blueprint for identifying the kind of wonderful business economics that Munger saw in See's Candies. It's a series of questions you must ask about any company before you invest, designed to cut through the noise and get to the heart of its competitive advantage. The first and most important question is the hypothetical price raise. Question. Imagine the company announced tomorrow that it was raising the price of its flagship product or service by 10% across the board. What would happen? Would customers revolt and flee to competitors? Would the CEO have to go on a press tour to justify the increase? Or would almost nothing happen? Would the vast majority of customers simply pay the higher price? A company with true pricing power can answer that question with confidence. Think of your Apple iPhone, your morning Starbucks coffee, or your family's annual trip to Disney World. These companies raise prices consistently, and while people might complain, they continue to pay. A business without pricing power, like an airline or a commodity steel producer, would face immediate and catastrophic loss of business if they tried the same thing. The second part of the litmus test is to analyze this from the customer's perspective, not. Ask yourself two things. First, is the product a small percentage of the customer's total budget? A $1 increase on a $5 box of chocolates or a 20-cent increase on a $2 can of Coca-Cola is almost unnoticeable to the end consumer. It's a rounding error. This makes price increases much easier to stomach. Second, is the product a must-have or merely a nice-to-have? More importantly, is it critical to the customer's operations or identity? For a business, switching its core accounting software is a massive, risky undertaking, creating huge switching costs and giving the software provider immense pricing power. For an individual, the brand of their running shoes or their luxury handbag is part of their identity, making them far less sensitive to price. Finally, you must look at the historical price action. Don't just guess. Look at the data. Has the company successfully raised its prices equal to or faster than the rate of inflation over the past decade? Go back and look at their annual reports and investor presentations. Companies with pricing power are proud of it and will often boast about their ability to realize higher prices. A company that consistently demonstrates this ability has a powerful economic engine. The pricing power litmus test moves your analysis away from the static, backward-looking numbers on a balance sheet and focuses it on the dynamic, forward-looking reality of the business's relationship with its customers. It is the single most important indicator of a truly wonderful business. The opposite of this approach, the path of the 99%, is to fall into the commodity business trap. Talk. This is the antithesis of a wonderful business, and it's where investment capital goes to die. A commodity business is one where the product or service is undifferentiated and interchangeable. The customer makes their decision based on one factor and one factor alone: price. Think of businesses like airlines, basic steel manufacturing, oil and gas extraction, or trucking. For an airline, a seat on a plane from New York to Chicago is largely the same, whether it's on Delta, American, or United. The customer will almost always choose the cheapest option. This creates a brutal, soul-crushing competitive environment. Investors who are drawn to these industries are often seduced by their cyclical nature. When the economy is booming, these companies can look incredibly cheap on a price-to-earnings basis. An airline might trade for 5 times earnings, and the investor thinks they've found a bargain, but they fail to understand the underlying economics. Because they have no pricing power, the only way to compete is on cost. This leads to vicious price wars that destroy profitability. These industries are also incredibly capital-intensive. Airlines have to constantly buy new multi-hundred-million-dollar airplanes just to stay in business. The returns on that invested capital are horrific. When a downturn inevitably comes, these companies face massive losses and often go into bankruptcy, wiping out shareholders completely. The psychological mistake is confusing a cyclical upturn with a good business. The investor sees rising profits and a low P/E ratio and thinks they've discovered a hidden gem. What they've actually discovered is a terrible business at the peak of its cycle. Munger and Buffett understood this better than anyone. They have consistently avoided these commodity-like industries for their entire careers. They know that even the most brilliant CEO cannot overcome the brutal economics of a business where you are a price taker, not a price maker. Investing in these traps is the polar opposite of buying a See's candies. Instead of a business that gushes cash with little investment, you get a business that consumes cash with little return. It is a surefire way to severely damage your long-term portfolio growth. The magic of a wonderful business like See's Candies and the horror of a commodity business can be seen with perfect clarity through one crucial financial metric: return on invested capital, ROIC, asterisk, asterisk. This is the direct financial connection, the number that quantifies the difference between a compounding machine and a capital-destroying treadmill. ROIC, in simple terms, measures how much profit a company generates for every dollar of capital that has been invested in it. It is the truest measure of a business's quality. Let's make this tangible. Imagine two businesses. Business A, our wonderful business, and Business B, our cigar butt. Both have $1 million of capital invested in them. Business A, with its strong brand and pricing power, generates $250,000 in after-tax profit. Its ROIC is a phenomenal 25%, $250,000 1 millionths. Business B, stuck in a competitive, capital-intensive industry, generates only $50,000 in profit. Its ROIC is a paltry 5%, $50,000 1 millionths. Now, here's where the magic of compounding takes over. Let's say both businesses retain all their profits and reinvest them back into the business. After 1 year, Business A now has $1.25 million in capital. Earning 25% on that new capital base, it will generate $312, $500 in profit the next year. Business B now has $1.05 million in capital. Earning its usual 5%, it will generate just $52, $500 in profit. The gap is already widening. Let's fast forward 20 years. Assuming both businesses continue to reinvest all their profits at their respective rates of return, Business A will have turned its initial $1 million of capital into over $86 million. Business B will have turned its $1 million into just $2.65 million. The difference is staggering. It's the power of a high rate of return applied over a long period of time. This is why Munger was so insistent on buying See's. He knew that the high ROIC of the business, its ability to take a dollar of retained earnings and generate a high return on it year after year, would eventually make the initial purchase price look like a pittance. The financial statements of a high ROIC business are a beautiful thing to behold. They show consistent profitability, low capital requirements, and a gusher of free cash flow. This is the financial fingerprint of a wonderful business, the engine that drives true long-term wealth creation, and the ultimate justification for paying a fair price for excellence. The lessons from the Berkshire textile mills and See's Candies had created a new, powerful framework: avoid bad businesses and pay up for wonderful ones. But this raised a crucial, practical question. What, precisely, is a wonderful business? It's not enough to speak in generalities. An investor needs a concrete analytical toolkit to identify these rare enterprises. This leads us to the third pillar of the Buffett-Munger philosophy: the anatomy of quality and the deconstruction of the all-important concept of the economic moat. A moat, just like the moats around medieval castles, is a structural feature of a business that protects it from competitors, allowing it to earn high returns on capital for very long periods. Finding companies with wide, sustainable moats became the central quest of the mature Berkshire Hathaway. The quintessential story of Buffett's search for the perfect moat is his historic investment in the Coca-Cola Company. The year was 1988. The stock market was still reeling from the Black Monday crash of October 1987, and fear was rampant. But Buffett, armed with his new quality-focused philosophy, saw not fear, but opportunity. He had been a consumer of Coke his entire life, drinking at least 5 cans a day. He saw his neighbors drinking it. He traveled the world and saw people in remote villages drinking it. He began to study the business not as a stock, but as an enterprise. And the more he studied, the more he became convinced that Coca-Cola was the perfect business, perhaps the most perfect business in the world. What did he see? He saw a moat so wide and deep it was almost incomprehensible. First, he saw an intangible asset of unparalleled power: the brand. Coca-Cola was not a beverage, it was an idea. It represented happiness, refreshment, and America itself. This share of mind, as he called it, was a psychological fortress. No competitor, no matter how much money they spent, could dislodge Coke from its position in the global consumer's brain. This brand power allowed Coke to charge a premium for what was essentially sugar water, leading to incredibly high gross margins. Second, he saw a brilliant business model that required astonishingly little capital from the parent company. Coca-Cola didn't own the bottling plants around the world. It operated on a franchise model. It sold the highly profitable syrup concentrate to independent bottlers who then bore the massive capital costs of the trucks, plants, and distribution. Coke was a royalty on the success of its partners. It was a capital-light compounding machine. He began buying the stock aggressively in 1988, investing over $1 billion, which was a massive portion of Berkshire's portfolio at the time. Wall Street was skeptical. Coke was seen as a mature, slow-growth company, and the stock wasn't statistically cheap by traditional Graham metrics. But Buffett wasn't buying the next quarter's earnings. He was buying the next half-century of global thirst. He understood that the durability of Coke's moat meant the business would continue to gush cash and compound its value for decades to come. His analysis was famously simple. He asked himself if he could be certain that more people around the world would be drinking Coke in 10 or 20 years than were drinking it today. The answer was a resounding yes. He saw the simplicity and the permanence of the product. The formula was virtually unchanged in 100 years. In a world of dizzying technological change, Coca-Cola was a rock of certainty. The investment was a monumental success, becoming one of the cornerstones of Berkshire's fortune and the ultimate case study in identifying and buying a business with a nearly impregnable economic moat. The power of a moat, like Coca-Cola's, is rooted in deep-seated psychological principles that govern human decision-making. The two most important are the mental availability heuristic and the power of social proof. The mental availability heuristic states that we tend to judge the likelihood or importance of something based on how easily an example comes to mind. If I say cola, what is the first word that pops into your head? For billions of people on Earth, that word is Coke. Decades of relentless advertising, ubiquity, and cultural saturation have ensured that Coca-Cola is the most mentally available product in its category. This is not a trivial advantage. It is a nearly insurmountable barrier to entry. When a thirsty consumer walks up to a vending machine or a convenience store cooler, they are not conducting a detailed analysis of their options. They are acting on a cognitive shortcut. They grab what's familiar, what comes to mind first. That is the power of mental availability. This is then massively amplified by social proof, our innate tendency to assume that the actions of others reflect the correct behavior in a given situation. We are herd animals. When we see that Coca-Cola is the best-selling soft drink in the world, that it's served at every restaurant, every movie theater, and every sporting event, we subconsciously conclude that it must be the best choice. If everyone else is drinking it, it must be good. This creates a self-reinforcing loop. The more people who drink Coke, the stronger the social proof becomes, which in turn convinces more people to drink Coke. A competitor launching a new cola is not just fighting against Coke's advertising budget. They are fighting against the ingrained social behavior of the entire planet. An economic moat, therefore, is not just a financial or strategic construct, it is a psychological one. It's an architecture of cognitive biases built in the minds of consumers. Understanding this is critical for any long-term investor. You must learn to identify businesses that have successfully hijacked these mental shortcuts to their advantage. These are the businesses that can maintain their pricing power and market share for decades, not because they have the best product in a clinical sense, but because they have built a fortress in the minds of their customers. This is the intangible asset that Buffett saw so clearly in 1988, an asset that the spreadsheets of most Wall Street analysts were utterly incapable of valuing correctly. To make this process of identification rigorous and repeatable, we need an applied mental model. Let's call it the four-part moat analysis. This is a blueprint that you, as an investor or entrepreneur, can use to systematically dissect a company's competitive position. Before you invest in any business, you must be able to clearly identify and articulate the source of its moat, and it must fall into one or more of these four categories. First, there are and intangible assets. This is where brands like Coca-Cola or Apple fit. It also includes patents, which provide a legal monopoly for a period of time, and government licenses or approvals that are difficult for competitors to obtain. Ask yourself, does this company have a brand that allows it to charge a premium price for a product that is otherwise similar to its competitors? Does it possess intellectual property or regulatory approval that locks out competition? Second, there are asterisk switching costs. This is an incredibly powerful and often underestimated moat. Switching costs are the one-time inconveniences or expenses a customer incurs to switch from one provider to another. Think about your local bank. Moving your checking account, direct deposits, and automatic bill payments to a new bank would be a massive headache. Even if another bank offers a slightly better interest rate, most people won't bother to switch. This inertia is a moat. In the corporate world, this is even more powerful. A company that runs its operations on software from a company like Oracle or Microsoft would face enormous costs, risks, and employee retraining to switch to a new system. This gives the incumbent provider a locked-in customer base and significant pricing power. Third, we have asterisk network effects. A business has a network effect when its product or service becomes more valuable as more people use it. The classic examples are credit card companies like Visa and MasterCard. The more merchants that accept Visa, the more valuable a Visa card is to consumers. The more consumers who carry a Visa card, the more essential it is for merchants to accept it. It's a powerful feedback loop that locks out new competitors. Social media platforms like Facebook and marketplaces like eBay operate on the same principle. The value is in the network, not just the technology. Finally, there are asterisk cost advantages. A company can have a durable moat if it can consistently produce its product or service at a lower cost than its rivals. This can come from economies of scale, where a company's massive size allows it to negotiate better prices from suppliers, like Walmart. It can come from unique process advantages, like the famously efficient manufacturing system developed by Toyota. Or it can come from a unique geographic location, like a gravel quarry located just outside a major city, giving it a huge transportation cost advantage over a more distant competitor. By using this four-part framework, you can move beyond vague notions of quality and begin to analyze businesses like a professional capital allocator. A truly great business will almost always have a clear and identifiable moat from one or more of these four sources. The failure to conduct this type of rigorous moat analysis leads the 99% of investors down the perilous path of asterisk chasing fads and growth without a moat. Asterisk. This is one of the most common and destructive mistakes in modern investing. The market is constantly swept up in narratives about the next big thing. Investors hear about a company with explosive revenue growth and pile in, assuming that growth will continue forever and lead to massive profits. But they fail to ask the most important question: what is stopping a competitor from doing the exact same thing? Consider the meal kit delivery craze with companies like Blue Apron. The company had incredible revenue growth in its early days. It went public with a huge amount of hype. Investors, seeing the growth, assumed it was the next great technology disruptor. But they failed the moat analysis. Did Blue Apron have any intangible assets? No, the brand was new and had little loyalty. Did it have switching costs? No, a customer could cancel their subscription with a single click and try a competing service. Did it have network effects? No, the service didn't become better as more people used it. Did it have a cost advantage? No, the logistics of packing and shipping fresh food were incredibly expensive, and competitors could easily replicate the model. What happened was predictable. Dozens of competitors flooded the market. The companies had to spend enormous sums on marketing to attract new customers who had no loyalty. Price wars erupted. Profitability was non-existent. The stock price collapsed, wiping out almost all of its value for those early investors. This pattern repeats itself in every market cycle with different industries: cannabis stocks, 3D printing, clean tech. The story is always the same. Rapid revenue growth in a new industry attracts a flood of competition. The companies that lack a genuine durable moat are inevitably competed into oblivion. The 99% chases the exciting story and the impressive growth numbers. The successful investor patiently looks for the boring, durable moat that protects the business from the ravages of competition. The direct financial connection between a wide economic moat and a company's financial performance is unambiguous and profound. A moat is not an abstract academic concept. It manifests directly in the numbers you can see on a company's income statement and cash flow statement. When you learn to read these statements through the lens of moat analysis, you can literally see the company's competitive advantage quantified. The first place to look is at asterisk gross margins. As we've discussed, gross margin, revenue cost of goods sold, reflects a company's pricing power. A company with a strong brand or a unique product, a moat built on intangible assets, can consistently command high and stable gross margins. Coca-Cola's gross margins have historically been in the 60% range. This means for every dollar of soda they sell, 60 cents is gross profit. Compare that to a typical grocery store, which operates in a brutally competitive, no-moat industry. Their gross margins might be in the low 20s. A software company with high switching costs might have gross margins of 80% or more. Consistently high gross margins are the financial signature of pricing power. Next, look at *nice net profit margins. Net margin is the bottom line. What's left after all expenses, including marketing, R&D, and administrative costs, are paid. Companies with wide moats tend to have higher net margins. Why? Because they don't have to engage in a life-or-death struggle for survival every single day. A company in a no-moat industry has to spend a huge percentage of its revenue on marketing, just to stay relevant or engage in constant price wars, both of which crush net margins. A company like Moody's, the credit rating agency, has a powerful moat due to regulation and reputation, intangible assets. It doesn't need a massive advertising budget. Its customers come to it. As a result, its net margins are extraordinarily high, often exceeding 30%. Finally, and perhaps most importantly, is *Marst free cash flow conversion. Free cash flow is the actual cash a business generates after all expenses and necessary capital expenditures are paid. This is the money that can be used to pay dividends, buy back stock, or make acquisitions. It is the ultimate goal of any for-profit enterprise. Wonderful, moated businesses are what Buffett calls free cash flow gushers. They are able to convert a very high percentage of their net income into free cash flow. This is because they are not capital intensive. See's Candies and Coca-Cola are perfect examples. They grow and profit without having to constantly pour money back into new factories. When you find a business with high and stable gross margins, high net margins, and a high conversion of net income to free cash flow, you have almost certainly found the financial footprint of a wide and durable economic moat. This is the engine that will compound your capital for decades to come. By this point in his evolution, Buffett had a clear, powerful two-part system. First, identify a wonderful business, protected by a wide, durable economic moat. Second, let it compound. But there was a missing piece, a critical question that every aspiring quality investor must grapple with. Okay, you might say, I understand I need to buy these great, moated businesses. But they're never cheap. Their quality is obvious to everyone, and their stocks always seem to trade at high valuations. This is a legitimate and crucial challenge. How do you reconcile the discipline of value investing, not overpaying for an asset, with the philosophy of buying the best businesses? This leads us to the fourth pillar of his genius, the price of excellence, and the art of reconciling quality with valuation. It's the understanding that you don't need a statistically cheap price. You need a price that offers an attractive long-term rate of return for the quality you are getting. The foundational anecdote that perfectly illustrates this principle is one of the greatest investment coups of Buffett's early career, his investment in American Express during the Salad Oil scandal of 1963. American Express at the time was seen as a blue-chip, unshakable financial institution. Its primary businesses were its highly trusted travelers' checks and its burgeoning charge card business, a status symbol for affluent consumers. However, it had a smaller, obscure division that did warehousing. This division would issue receipts against goods held in its warehouses, and other banks would lend money to the owners of the goods with the receipts as collateral. One of its biggest clients was the Allied Crude Vegetable Oil Refining Corporation, run by a charismatic fraudster named Tino DeAngelis. DeAngelis had managed to secure massive loans against his company's inventory of salad oil, which was stored in American Express's warehouses. In November 1963, the scandal broke. It was discovered that DeAngelis's giant tanks of salad oil were mostly filled with water. The fraud was epic in scale. Allied Crude collapsed, defaulting on loans worth what would be over $1.5 billion in today's money. The banks that made the loans, holding worthless warehouse receipts, turned to American Express, claiming it was liable for their losses. Wall Street panicked. The market feared that the potential liabilities would bankrupt American Express, a pillar of the financial establishment. The stock, which had been trading at over $60, collapsed by more than 50%, plunging into the 30s. It looked like a falling knife. To the market, the brand was tarnished, and the company's survival was in question. This is where Buffett, the newly evolving quality investor, saw an opportunity born from chaos. He didn't just look at the plunging stock price. He did the hard, on-the-ground work of a business analyst. He knew the key question was whether the scandal in the obscure warehousing division had permanently damaged the core, wonderful businesses, the traveler's checks, and the charge cards. So he went out and did his own research. He visited restaurants and hotels, talking to cashiers and managers, asking if they were still accepting American Express cards and checks. He went to banks and talked to tellers, asking if they had seen any drop-off in travelers' check sales. He even talked to competitors. The answer he got back was unanimous. Nobody cared about the salad oil. Customers still saw the American Express card as a badge of honor, and merchants still saw it as a magnet for high-spending customers. The travelers' checks were still considered as good as gold. Buffett concluded that the company's economic moat, its powerful brand, and the trust it commanded, was completely intact. The market, in its panic, was conflating a problem in a small, non-core division with the entire enterprise. He calculated that even in a worst-case scenario where Amex had to pay all the claims, the loss would be manageable and would not permanently impair the incredible earning power of its core businesses. The salad oil scandal had created a once-in-a-decade opportunity to buy a truly wonderful, moated business at the price of a broken cigar butt. He invested a staggering 40% of his partnership's capital into American Express stock, his biggest investment ever at the time. Over the next few years, as the company settled the claims and its powerful core businesses continued to grow, the market's fear subsided. The stock price soared, and Buffett's partners made a fortune. This was the ultimate synthesis of his old and new philosophies, using a moment of extreme market fear to buy an exceptionally high-quality business at a more than fair price. The American Express saga is a perfect illustration of the psychological forces that create these rare opportunities. The market's reaction was driven by an asterisk availability cascade asterisk and the raw, primal emotion of fear. An availability cascade is a self-reinforcing process where a collective belief gains more and more plausibility through its increasing repetition in public discourse. The salad oil scandal was a dramatic, easily understood, and terrifying story. The media ran with it. Every headline screamed about fraud, deception, and potential bankruptcy. The story was highly available to every investor's mind. This triggered a wave of panic selling. When investors see a stock plunging and read terrifying headlines, the rational, analytical part of their brain, the prefrontal cortex, is hijacked by the amygdala, the center of fear and emotion. The instinct is to sell first and ask questions later. This creates a feedback loop. Fear leads to selling, which drives the price down further, which generates more scary headlines, which creates even more fear. Buffett's genius was his ability to remain rational while everyone else was panicking. He is famous for his advice: Be fearful when others are greedy, and greedy when others are fearful. This is not just a clever aphorism, it is a profound psychological discipline. It requires an investor to actively counter-program their own innate emotional responses. While the market was caught in the availability cascade, reacting to the vivid narrative of the scandal, Buffett was focused on the underlying, unchanging reality of the business. He was able to separate the temporary, emotional noise from the permanent economic signal. This emotional fortitude, this ability to be a calm observer of mass hysteria, is just as important as the analytical ability to identify a great business. Most investors fail not because they can't find good companies, but because they lack the temperamental control to buy them when they are cheap, which is usually during times of fear, and hold them when they are volatile. The salad oil scandal shows that the best prices for the best companies often appear only when there is blood in the streets. To consistently execute this strategy, you need a mental model for valuation that is robust enough to handle uncertainty and focused on the long term. Forget about complex, multi-tabbed spreadsheets that try to predict earnings to the penny. A more effective blueprint is what we can call asterisk, the 10-year earnings bridge. Asterisk. This model shifts your focus away from the noise of the present and forces you to think like a business owner. It's a simple, back-of-the-envelope calculation designed to determine if today's price offers an attractive potential rate of return over a business-like time horizon. Here's the four-step process. First, you must estimate a conservative growth rate for the company's earnings per share (EPS) over the next 10 years. This is the most subjective part, but it should be based on the company's historical performance, the strength of its moat, and the growth prospects of its industry. For a dominant, stable company like Coca-Cola, you might project 7% annual growth. For a more dynamic company, maybe you project 12%. The key is to be conservative and reasonable. Second, using that growth rate, you project the earnings per share in year 10. Stable 10. This is simple compounding. If a company earns $5 per share today and you project 10% growth, in 10 years it will be earning about $13 per share. Third, you apply a reasonable price-to-earnings (PE) multiple ties to that future earnings figure. What will the market likely be willing to pay for this business in a decade? You could use the historical market average of around 15x, or the company's own long-term average PE. If we apply a 15x multiple to our hypothetical company's $13 of EPS, we get a target stock price of $195 in 10 years. Finally, you discount that future price back to today to see if the current price offers an attractive return. If the stock is trading at, say, $75 today, and your model suggests it could be worth $195 in 10 years, that represents an annual compound return of about 10%. Is a 10% annual return good enough for you, considering your other options and the risk involved? This model's power is in its simplicity and its perspective. It moves the valuation question away from the unanswerable "is this stock cheap today?" to the more practical business owner question, if I buy this company at this price, what is my likely rate of return over the next decade? It provides a disciplined framework for paying a fair price for quality without falling into the trap of overpaying. This balanced approach allows you to avoid the two extreme and equally destructive paths of the 99%, the growth at any price and the value trap mindsets. The growth at any price investor gets swept up in market manias. During the dot-com bubble of the late 1990s, investors were paying literally any price for technology stocks, many of which had no earnings and no clear path to profitability. They abandoned all valuation discipline, justifying their purchases with narratives about, quote, new paradigms. When the bubble burst, they were annihilated. This mindset reemerges in every bull market, seducing investors into believing that a good story is a substitute for a good price. On the opposite extreme is the rigid, value trap investor. This is the investor who learned the lessons of Ben Graham, but never moved on to the lessons of Munger. They are so dogmatically attached to buying stocks at statistically cheap levels, a P/E ratio below 10, a price-to-book ratio below 1, that they systematically exclude all of the world's greatest businesses from their portfolio. A company like Microsoft or Visa will likely never trade at 8 times earnings. They are too good, and the market knows it. The value trap investor, by refusing to pay a fair price for excellence, dooms themselves to a portfolio of mediocre, slow-growing, or structurally challenged businesses. They own the modern-day equivalent of Buffett's textile mills. They win a few small battles, collecting their cigar butt puffs, but they lose the war for long-term compounding. Buffett's genius was in finding the synthesis between these two failed extremes. He maintained Graham's discipline about not overpaying, but learned from Munger to be flexible on his valuation metrics when presented with a truly exceptional, moated business. This is the narrow path to wealth, avoiding the ditches of speculative excess on one side and rigid mediocrity on the other. The direct financial connection of this principle is best understood through Buffett's own preferred valuation metric, **owner earnings**, and its relationship to a discounted cash flow (DCF) analysis. Buffett found that standard accounting net income was often a poor representation of a business's true economic reality. A company could report high net income but still be a terrible business if it had to spend all that income on capital expenditures just to maintain its position. So he developed the concept of owner earnings. The formula is simple: net income plus non-cash charges like depreciation and amortization, minus the average annual amount of capital expenditures required to maintain the business's long-term competitive position. This figure gives you a much more honest picture of the actual cash the business is generating that is available to be distributed to its owners. This is the real profit of the enterprise. This concept of owner earnings is the critical input for a discounted cash flow analysis, which is the theoretical bedrock of all valuation. The DCF model states that the intrinsic value of any business is the sum of all its future owner earnings, discounted back to what they are worth in today's money. $1 tomorrow is worth less than $1 today, so we have to apply a discount rate. While the math can seem complex, the concept is simple. You are buying a future stream of cash flows. A high-quality business like the one Buffett saw in American Express has a future stream of owner earnings that is large, predictable, and growing. A low-quality business has a future stream that is small, volatile, and shrinking. Therefore, the present value of the high-quality business is vastly higher. The market's panic during the salad oil scandal caused it to dramatically and incorrectly lower its estimate of American Express's future owner earnings. Buffett's analysis showed that this was a temporary misjudgment. By focusing on the true, long-term cash-generating power of the business, he was able to see immense value where others saw only risk. This focus on owner earnings is the financial toolkit that allows an investor to confidently pay a higher multiple for a great business, knowing that the torrent of future cash flows will more than justify the price. We have now assembled the core components of the Buffett-Munger machine. We've learned to reject the seductive trap of the cigar butt, to instead seek out wonderful businesses with wide economic moats, and to have the discipline to buy them at fair prices when opportunities arise. But how do you put it all together? How do you translate these principles into a coherent, real-world portfolio strategy that you can implement for your own financial freedom? This brings us to the fifth and final pillar, the compounding machine in action, and how to construct your portfolio as a fortress of quality. This is where philosophy becomes practice, transforming individual stock picks into a powerful, unified engine for wealth creation. The ultimate modern anecdote for this pillar, the one that perfectly encapsulates the culmination of all these lessons, is Buffett's monumental investment in Apple. For decades, Buffett famously avoided technology stocks. He often said they were outside his circle of competence. The industry changed too quickly, and he felt he couldn't predict what the competitive landscape would look like in 10 or 20 years. This made him a subject of criticism, especially during the dot-com boom. But in 2016, the world was shocked to learn that Berkshire Hathaway had begun buying billions of dollars worth of Apple stock. By 2018, it had become Berkshire's single largest holding. What had changed? Did the 87-year-old investor suddenly become a tech guru? The answer is no. Buffett didn't change his principles. He recognized that Apple had changed from a volatile tech company into the exact type of business his philosophy was designed to identify. He didn't analyze Apple as a technology company. He analyzed it as a consumer products company with one of the most powerful moats in modern history. He saw the iPhone not as a piece of hardware, but as the center of a vast and sticky ecosystem. Once a customer bought an iPhone, they bought apps from the App Store, stored their photos in iCloud, and listened to music on Apple Music. Their digital life became intertwined with Apple's products. This created immense and rising switching costs. To leave the Apple ecosystem for a competitor like Android would be a massive, time-consuming, and frustrating process for the average user. He saw a brand with fanatical loyalty, an intangible asset on par with Coca-Cola. He saw a company with incredible pricing power, able to consistently launch new, more expensive phones that customers would line up to buy. He saw a business that was surprisingly capital-light relative to its enormous profits. And most importantly, he saw a management team, led by Tim Cook, that was relentlessly focused on returning capital to shareholders. Apple was generating hundreds of billions of dollars in free cash flow and using a huge portion of it to buy back its own stock. Buffett understood that this investment wasn't a bet on the success of the iPhone 11 versus the iPhone 12. It was a bet on the durability of the ecosystem, the power of the brand, and the intelligence of its capital allocation. It was See's Candies, Coca-Cola, and American Express all rolled into one, but on a scale the world had never seen. The Apple investment is the ultimate testament to the enduring power of his principles, proving they are not tied to any specific industry, but are a universal framework for understanding business quality. The portfolio strategy that emerges from this philosophy is built upon the powerful psychological principles of simplicity, and the circle of competence. Buffett's approach is the polar opposite of the hyper-diversified, own a little bit of everything strategy common in modern wealth management. His portfolio is highly concentrated in a handful of businesses that he understands deeply. This is a direct assault on the overconfidence bias, and the illusion of knowledge, two cognitive traps that ensnare most investors. The investor who owns 50 or 100 different stocks doesn't truly understand any of them. They have the illusion of knowledge because they can recognize the company names, but they have no deep insight into their business models or competitive advantages. By contrast, Buffett's concentrated approach forces profound intellectual honesty. You cannot afford to be wrong when a single position represents a huge portion of your portfolio. This forces you to do the deep, rigorous work required to truly understand a business. This is the essence of the circle of competence. It's not about how big your circle is. It's about knowing precisely where the perimeter lies and staying strictly within it. This strategy also builds a powerful psychological fortress. When a market crash occurs, the investor with 50 stocks they barely know will look at their sea of red and panic. Their portfolio is an abstraction, a list of tickers. The concentrated quality investor, however, sees the stock prices of their 8 or 10 wonderful businesses go down and thinks, I own a piece of Coca-Cola, a piece of Apple. These are incredible businesses. The market is giving me a chance to buy more of them at a discount. Their deep understanding of the underlying businesses transforms fear into opportunity. It's a temperamental advantage that is far more important than any analytical skill. To bring this powerful idea into your own life, you can use one of Buffett's most famous mental models, the 5-slot punch card portfolio. Imagine that at the beginning of your investment life, you are given a punch card with only 20 slots on it. Each time you make an investment, you have to punch a hole. Once you've punched all 20 holes, you can't make any more investments for the rest of your life. This mental exercise has a profound effect. It immediately eradicates casual, low-conviction, let's take a flyer on this type of stock picking. every decision becomes immensely important. For most of us, starting with 20 slots is too many. Let's simplify the blueprint to a 5-slot punch card. Before you buy a single share of any stock, you must ask yourself this question. Is this business so wonderful, is its moat so wide, and is its price so fair that I would be willing to put 20% of my entire net worth into it and have it be one of my only 5 lifetime investment decisions? This is an incredibly high bar. It will force you to say no to 99.9% of the ideas that cross your desk. It will compel you to do the deep, difficult work of moat analysis and valuation. It will force you to wait patiently for the truly exceptional opportunities. But the few yeses you arrive at will be the ideas that truly build wealth. This mental model is not about literally creating a 5-stock portfolio, although that may be the result. It's about cultivating a mindset of extreme selectivity, patience, and high-conviction betting. It is the ultimate antidote to the scattered, unfocused approach that leads to mediocre results. The path of the 99%, the antithesis of this focused strategy, is the trap of diversification, core 2. This term, coined by the great investor Peter Lynch, describes the all-too-common practice of over-diversifying a portfolio to the point of impotence. Most retail investors and indeed many professional financial advisors are taught that diversification is the ultimate safety measure. They are encouraged to own dozens or even hundreds of stocks, or more commonly, a basket of mutual funds that each own hundreds of stocks. The result is a portfolio that effectively mimics the entire market. This strategy achieves only one thing with certainty. It guarantees you will get average, market-like returns, minus the fees you pay to the fund managers and advisors. This approach is not born from knowledge. It is born from fear and ignorance. Because the investor doesn't truly understand any of the individual businesses they own, they feel they must own all of them to be safe. It is an admission that they don't know how to distinguish a great business from a poor one. Buffett calls this approach fine for the know-nothing investor, for whom a low-cost index fund is the best option. But for the investor who is willing to do the work, the know-something investor, diversification is a catastrophic error. It dilutes the impact of your best ideas. If you find a truly great investment, but it's only 1% of your portfolio, its success will have a negligible impact on your overall wealth. Concentration, on the other hand, allows your best ideas, the fruits of your most rigorous labor, to have a meaningful and life-changing impact. The path of the 99% is to trade the potential for exceptional returns for the illusion of safety, an illusion that often shatters in a real market crisis anyway. The final, powerful financial connection that makes a quality-focused, concentrated portfolio so effective is the role of share buybacks and capital allocation as an accelerant. This is a concept that is poorly understood by most investors, but it is a critical engine of long-term returns. When a wonderful, cash-gushing business is trading at a fair price, the single best thing it can do with its excess cash is to buy back its own shares. Let's use a simple example. Imagine a company has 1 million shares outstanding and earns $1 million a year, so its earnings per share, EPS, is $1. You own 100 shares. The company has $100,000 of excess cash. It can either pay that out as a dividend of 10 cents per share, or it can use that $100,000 to buy back its own stock. Let's say the stock is trading at $10 per share. With its excess cash, the company can buy back 10,000 shares. Now there are only 990,000 shares outstanding. The company still earns $1 million next year, but now its EPS is $1.01. Your earnings per share went up by 1% without the company having to sell a single extra product. You didn't have to invest another dime, but your ownership stake in the company's earnings stream just grew. Now imagine a company like Apple, which buys back tens of billions of dollars of its stock every single year. This acts as a massive, continuous tailwind for the remaining shareholders. It's a highly tax-efficient way to return capital, and it dramatically increases earnings per share over time, which in turn is a primary driver of the long-term stock price. This powerful accelerant is a benefit you only get with truly high-quality, cash-generating businesses. Cigar butts and mediocre companies don't have the excess cash to buy back stock. They are too busy pouring it into their failing operations. By concentrating your portfolio in these capital-returning machines, you are not just betting on the success of their business operations, you are harnessing the immense mathematical power of their intelligent capital allocation strategy to compound your own wealth. You have just fundamentally rewired your investment brain. You've traveled from the dying textile mills of New England to the candy counters of California, from the global ubiquity of Coca-Cola to the digital ecosystem of Apple. You have absorbed the single most powerful shift in financial thinking of the last century, the transformation from a price-first investor, a hunter of cheap things, to a business-first investor, a partner in wonderful enterprises. You now possess the mental models to distinguish a true bargain from a value trap, to dissect a company's competitive defenses, and to think rationally about the price of excellence. This is a formidable intellectual arsenal. But identifying a wonderful business is only one half of the equation. It is the analytical half. The other half, the part that separates the temporarily successful from the generationally wealthy, is the temperamental half. It's the psychological fortitude required to hold these great businesses through the terrifying chaos of market crashes. It's the deep understanding of capital allocation that allows you to harness the full, explosive power of their compounding engines. Having the right map is essential, but having the discipline and courage to follow it through the darkest parts of the forest is what ultimately determines whether you reach the destination. The video that is now appearing on your screen is the bridge across that gap. It is the next crucial piece of the intellectual puzzle. It moves beyond what alone to buy and delves into the critical questions of asterisk, how to hold, when to add, and how to build the unshakable psychological foundation that underpins all great fortunes. Most people will stop here, content with the theory they have just learned. They will feel smart for a day, and then fall back into old habits when the market turns. But for the few of you who are truly serious about this journey, for those who see investing not as a hobby, but as the craft of building your own financial freedom, completing your mental toolkit is not optional. The choice to click is not a choice to watch another video. It is a declaration that you are continuing your ascent. The next link in the chain of knowledge is waiting for you. The final promise is to yourself: continue the journey.